Hi, Masters Advanced Accounting class. Truth be told, I already messed up on my first video, so I am going to point to the different parts of this problem. All right, this problem is going to be a continuance of the following question. ProTrade Corporation acquired 80% of the outstanding voting stock of Seacraft Company on January 1st, 2020 for $612,000 in cash and other considerations. This particular problem, they gave you sales, they gave you cost of goods sold for both the parent and the sub. So in this particular instance, the parent is ProTrade and the subsidiary is Seacraft. In this video, I'm going to go over how to do C. I have prior videos for A and B. Here's C. ProTrade sells Seacraft a building on January 1st, 2020 for $128,000, although its book value was only $74,000 on this date. The building had a 5-year remaining life and was to be depreciated using the straight line method with no salvage value. I need all that information in order to figure out this problem. Okay, first thing you determine, who sold to who? The parent sold to the sub. So in this case, you're going to have a downstream sale. What does that mean? That means for net income for Seacraft, we won't have to take into account this deferral of this gain with this fixed asset. All right, so I've started it over here. Like I said, it's my second time doing the video. So ProTrade, their consolidated buildings was initially $382,000. They're asking for you, what is the consolidated piece? Seacraft, their initial amount for their building was $181,000. Next, you need to account for the removal write-up of this transfer. So basically, your textbook doesn't call it a gain, but it's a gain between the parent and the sub. All right, so what happened? The parent had a book value of a building on their books for $74,000. Well, they sold it to this subsidiary for $128,000. Basically, that's a gain of $54,000. Well, they can't recognize that gain. Think about it. Think about how illegal that would be. The parent would be selling to their sub all the time and marking these things up. So the Financial Accounting Standards Board says, nope, you can't recognize that gain until you sell to an outside party. If you sold to an outside party, yes, you could recognize the gain. All right, so what is it? So the removal of the write-up created by the transfer, they sold it for $128,000. They had $74,000 in the books. $54,000 is the write-up of the transfer. Next, you need to depreciate that write-up. So you're trying to figure out what the original cost was on the parent's books. So you're going to take the $54,000, you're going to divide that by 5, and that gives you $10,800 per year. That's the depreciation. Well, this question is asking for 2021, so we need 2 years, 2020 and 2021. So we're going to take the 10,800 and we're going to multiply that by 2, and that gives us 21,600 for depreciation. Now, we're going to net these two. We're going to net these two, and this is in parentheses, 54,000 minus 21,600. Well, this is a negative positive, so you have a negative over here of 32,400. Now, you're going to take the 382 plus the 181. You will subtract out that net effect of 32,400. You get 530,600 for your consolidated amount for the buildings. The next question is going to ask, what is the consolidated amount for the expenses? If you look at the answer from the publisher, they call it ProTrade's book value. I think that's confusing, so I've renamed that for you. It's ProTrade's operating expenses, because you're trying to figure out the consolidated expenses. Operating expense for ProTrade is $174,000. The operating for Seacraft is $129,000. All right, now you're going to remove the excess of depreciation, which is $10,800, and that's how you get the $292,200. So you might be thinking, Professor Clay, wait a minute. Over here, we eliminated $21,600. We took into account 2 years of depreciation. This one, we're only taking in 1 year. Why? Because this is 2021. This is asking for the expenses. Remember, expenses are only for 1 year. The last year, the prior year, we already did. We already figured that out. We closed that to retained earnings. So that's why this year we will only recognize 1 year. Total that up, $292,200. Now let's go to the net income. So then it's asking what is the net income attributed to the controlling interest. I showed you the total, even though the publisher, they just show you the 154. I showed you how you get the 154. You're going to look at the subsidiaries, sales, their COGS, their operating expenses. You'll come down to the subsidiaries, Seacraft's 154. You'll multiply it by what they don't own, 20%. So the non-controlling interest for this is $30,800. And that's how you do an inter-entity sale of a fixed asset. I'll see you soon.